Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, let me introduce myself. My name is Mohamad Aziz Habibie.
This time I will discuss learning about understanding accounts, 5 types of accounts, explain the normal balance for each account, and how to enter transactions into the general journal.
Definition of account.
Accounts are accounting records used to record financial transactions and explain changes in assets, liabilities, capital, income, and expenses.
Accounts are the most basic form of summary in accounting. In accounting, accounts have several functions, including record financial transactions chronologically based on transaction date. B describes additions or reductions to specific assets, liabilities, or equity. C becomes the basis for preparing financial reports. Accounts are divided into 2, namely real accounts and nominal accounts. Real accounts are a group of accounts that are recorded and reported in the balance sheet of financial statements. Meanwhile, nominal accounts are a group of accounts whose transactions are recognized in the profit and loss statement. Apart from accounting, accounts can also mean accounts at banks and/or other financial institutions. B. User account, namely a user who can access a computer system or email address. C. Internet accounts, namely accounts created within a limited system established by an internet-based service. B. Types of account in accounting. 1. Asset. Assets are defined as resources owned by an entity that are obtained from past events and provide future economic benefits. The resources in question can be tangible or intangible. Current assets. Here are some examples of current asset accounts: cash, banknotes, coins, balances in bank accounts, and checks. Promissory note, a written undertaking by a customer to pay a sum of money on a certain date. Accounts receivable, future cash payments for the sale of goods or services on credit. Supplies, short-lived company items, such as pens and paper. Prepaid expenses, rent paid in advance, and insurance paid in advance. Non-current assets. Meanwhile, here are some examples of non-current asset accounts. Long-term investments, investing in stocks or bonds. Fixed assets, buildings, land, machinery, and equipment. Intangible assets, patents, copyrights, and goodwill. 2. Liabilities. The second type of account in accounting is liabilities. Liabilities are obligations that arise from past events, where the settlement is expected to result in an outflow of resources. Liabilities are divided into 2, namely long-term and short-term liabilities. Examples of accounts that fall into the liability category are as follows. Long-term liabilities. Examples of long-term liability accounts are long-term bank debt, deferred tax liabilities, warranty liabilities, bond issuances, and lease liabilities. Short-term liabilities. Examples of short-term liability accounts are electricity bills, water bills, telephone bills, employee wages, checking account credits, and sales and income taxes. 3. Owner's equity. Owner's equity is the residual interest in assets after deducting all liabilities or obligations. Owner's equity in a partnership or sole proprietorship usually consists of the owner's capital account. An example of owner's equity, for example, is you own a house worth Rp 500.000.000, but you owe Rp 100.000.000 to buy the house. So, the owner's equity is Rp 500.000.000, Rp 100.000.000 equals Rp 400.000.000. 4. Revenue. Revenue accounts are also included in the types of accounts in accounting that you must know. Revenue is an increase in equity due to the delivery of goods and services to consumers. If there are many types of income, then each needs to be recorded in a separate account. In fact, the term income is more often used by service companies, while manufacturing companies. Some examples of revenue accounts in accounting are as follows: commission income, professional service income, rental income, sales, interest income. 5. Expenses. Expenses are the last types of accounts in accounting. Expenses are defined as costs incurred to obtain goods or services whose benefits can be felt for up to 1 year or more. So, this expense is specifically for goods that have no benefits after 1 year. In this case, it is very normal for the company to issue an expense because it is an effort to. Miscellaneous expenses, rental expenses, equipment expenses, salary expenses. See normal balance. Normal balance is a concept that regulates financial recording. Normal balance shows the standard position an account is in the debit or credit statement. Normal balance is important in bookkeeping because it is used to analyze financial statements. A function of normal balance in accounting. Here are some important functions of normal balance in accounting. 1. Financial recording guide. 2. Financial report compliance. 3. Monitoring financial health. 4. Basis for decision making. 5. Tax and legal compliance. D. Types of normal balance in accounting. 1. Normal balance in asset accounts. For an asset account is a greater debit balance than a credit balance. This shows that the debit side has a greater influence on the asset account. 2. Normal balance in liabilities accounts. The normal balance of a liabilities account is the credit side. 3. Normal balance in equity accounts. The normal balance of an equity account is a credit. The credit balance in the equity account shows the wealth gained from building the business. 4. Normal balance in revenue accounts. The normal balance of the revenue account is a credit. The normal account balance is the positive difference between the debit and credit sides of an account under normal circumstances. The normal balance of the revenue account relates to the activity of selling goods or services. Income is the result of acquiring assets or economic resources from other parties. 5. Normal balance in expense accounts. The normal balance of an expense account is a debit. This is because the cost account is on the right side of the basic accounting equation, but has a negative sign. E. How to enter transactions into the general journal. To enter transactions into the general journal, follow these steps. 1. Transaction identification. Determine the transaction that occurred and identify the accounts involved. For example, purchasing goods, selling, or paying debts. 2. Define debit and credit accounts. Every transaction will affect at least 2 accounts. Determine which accounts will be debited and which will be credited. The basic principle of accounting is that debits must equal credits. 3. Record date. Write the transaction date in the appropriate column. For transaction description, provide a brief description of the transaction to explain the context. 5. Enter amount. Write the appropriate amount in the debit column for debited accounts and in the credit column for credited accounts. 6. Mark the journal. After recording, make sure to check and mark the journal so that the transaction is recorded correctly. Example, if you buy goods for IDR 1 million in cash. Date, October 1st, 2024. Debit account, inventory, 1 million Indonesian rupiah. Credit account, cash, 1 million Indonesian rupiah. Description, purchase of goods. The general journal will look like this. Date description debit, credit. January 10th, 2024 inventory IDR 1 million. Cash IDR 1 million. Purchase of goods. Maybe that's all the explanation of the material from me. If there are any mistakes in pronunciation, please forgive me. That's all from me, and thank you for watching this video until the end. Wassalamu'alaikum warahmatullahi wabarakatuh.